Hi, class. I will be completing 3 videos with the intention of demonstrating some of the concepts that we are covering in Chapter 7, not all. In these tutorials, I will be working a problem using a software, not Pearson and not Cengage. I'm just going to use this software. And what I would like to do is show you how to analyze various problems depending on what we're trying to solve. In some cases, we're actually preparing a statement, or in some cases, we're computing the break even or the margin of safety. So those concepts require some practice, but I do want to demonstrate. This is something that I would have done in class, but since we are on social distancing mode, I would like for us to continue to work problems. And the best way to do that is in a video like this. So let me know if it's helpful. I think it might very well be helpful because you could always go over it again and again and again until you get it. What you see on your screen is a problem. It says the following costs result from the production and sale of 1,000 drum sets manufactured by Tom Thompson Company for the year ended 2013. The drum set sells for $500 each. The company has a 25% income tax rate. Here is some data that relates to it. Now, what we want to do is, using this information, we want to prepare an income statement, but a contribution margin income statement, which is very different from what you would normally prepare for financial statement, financial reporting. Okay, so that being said, let's do it. I'm going to click out of here and I'm going to go right into the problem, but I'm going to go into the problem as a student. So let's work these problems together. And hopefully with all these problems, you should be able to do the problems on your homework. So here we are. All right, so here's the problem. Now let's work it out. Now remember, an income statement is going to have, for managerial purposes, an income statement is going to be very similar. Not totally different, but very similar. So don't worry, it's not completely foreign. We want to first start with the sales. And we were told, and I'm going to get my computer, my cell phone, because I'm going to be using it for calculating things, and I don't want to have to switch screens. So with that being said, the first thing we want to do is we want to calculate what the income is. So if we take the income, which is given to us, of $500 per jump set, $500 each. Now they're going to be selling 1,000 of them. So I already know that my income is going to be $500,000. So far, so good, right? Okay. Now, with a contribution margin statement, remember we talked about this. It's a little different from the income statement in that we're going to take our variable costs. Okay, so I'm going to square out a little bit so you can take a look. We're going to be reducing our sales by our variable costs to come to our contribution margin. So let's deal with the variable costs, which are noted here. Plastic for casing. I'm going to put that there, plastic for casing. And they gave me the amount of 82,000. So I'm going to put that there. Next, I want to talk about the wages of the assembly workers. Hopefully this would work. There you go. Wages for assembly workers. And according to that, it is about 82,000. No, not 82. Yes, 82,000. I have to change this one. I think I made a boo-boo. It's 17,000. I'm sorry. $17,000 for plastic for casing. So far, so good. And then now we have our drum stands, which is 26,000. And I'm going to go down to drum stands. And I'm going to put the 26,000. And finally, I have to consider costs that change. And the other cost that change is going to be the variable costs related to selling, which is going to be the commissions. I think it's going to be called sales commissions. Yes. And that's going to be 15,000. So if we take our variable cost of 140,000 and we subtract the 500,000, our contribution margin then becomes, let me get my, looks like 360,000. And because I'm doing it this way, I want to be able to make certain we check our work. And I think in your software program, you are allowed to see your answers and see if they're correct, but I don't know for sure. This is a different software program. So far, my numbers look good. They actually look good. So I'm going to close it, go back to where I stopped. Now, we are halfway done. Now we have to consider our fixed costs, and they are delineated here. So we're going to create our fixed costs, and starting with taxes on factory, I come up to an amount of $5,000. Then the next is going to be factory maintenance, and that's about $10,000. The next is going to be our factory depreciation, and that's about 40 grand. And then we also have to deal with lease of our equipment for sales staff, and that's about 10,000. And see, and it's really relatively straightforward. The main thing here is that we breaking out costs based on variable and fixed. And that's really what makes it different. Administrative costs, administrative management fees, hold on, administrative management salaries. And that's about 125,000. So we come to 226,000. I think I might be off. Let me make certain I got my numbers right. 5,000, 10,000, 40,000, 10,000, and 35,000. This one here looks like it's wrong. 35,000. Miskeyed. So now we have our fixed costs. What do we get once we take our fixed costs and add them to the equation? We're going to get our pre-tax income. And that's going to be what's actually going to be the difference between our costs and our contribution margin. So in this case, it's 360,000, subtract from 225,000 to arrive at $135,000. It's our pre-tax income. Now we have to consider our income tax, and I think it tells us here, income tax is 25%. So we're going to take and put here income tax. There we go. And I'm going to multiply the 135 times the 25%, 135,000 to come up with 33,750. And now we can say this is in fact, our net income. And our net income is going to be the difference between the 135,000 and the 33,750. I get 101,250. So far, so good. Now we can also do the same thing under a partial. So let's do by unit. We're going to do the actual contribution margin, but we're going to do it by unit. So let's do it. We know our sales is $500 per unit, so that gave it to us. So we can put $500 here. And our variable cost by unit, how do we get that? What do we do to get our variable cost by unit? Let's think about that for a second, and then we're going to finish up this particular problem. Now, we have to think about this part of the actual income statement when you base it on units. We have to compute what the per unit variable costs are for each one of the components loaded here. So what I'm going to do for ease, I'm just going to put the items here first. Plastic for casing, wages of assembly workers, and drum stands, and I believe sales commissions. Now, how do we determine what the per unit variable costs are? Well, we have some information that is very helpful to us. We know that we're going to be producing 1,000 drum sets. So to find out what the variable cost is, we have to take this plastic for casing in this case and divide by the number of units that costs make up. So for example, we're going to take 17,000 and divide by 1,000. That should give us $17 per unit it costs. The next step then is to take the $82,000 and multiply and divide it by the 1,000 units, and I get $82 per unit. And then we do the exact same thing with the drum stand, which is going to be the 26,000 divided by the 1,000, and that gives us $26 per unit. Now the math on this is quite easy, but it does give you an idea. When we're trying to determine what our variable amount is, we have to divide by the number of units that particular that we're producing. So in the case of sales commission, it's going to be $15 because we're dividing the 15,000 by the 1,000 units. So now we have $140 per drum it costs in variable costs. So now we can take our contribution margin by unit, because we're going to take the $500 that we sell it for, the selling price, and we're going to subtract the $140 variable costs. So we come up with $360. Oopsie. $360. So far, so good. Now that's very, very straightforward, not too difficult. I just want to reiterate, when we're preparing the contribution margin income statement, we're going to be breaking out the variable costs, because we know that the sales minus variable costs is going to give us our contribution margin. But because we're asking for a contribution margin income statement, we have to consider our fixed costs, which are noted here. And again, your problems in your textbook should not be vague in this regard. It should be very, very clear what's fixed costs and what's variable costs. And in preparing the income statement, the contribution margin income statement, we are very clear as to the separation of the variable costs and the delineation and separation of the fixed costs to come up with our pre-tax income and our net income. Also, using the same information, converting it from dollars to units is relatively straightforward, because we already know how much we're going to sell it for by unit. The question then becomes, how do we compute our per unit variable costs? And all we need to do is take our costs and divide it by the number of units that we're going to be producing. I hope this one demonstration is very helpful to you, and if you stay tuned, we'll go over how to compute the break even.